A well-thought-out strategy that strikes a balance between growth, risk management, and disciplined saving is required in order to successfully invest for early retirement. The objective is to amass sufficient capital to maintain your standard of living without having to rely on the conventional retirement age, which is normally about 65 years of age. The following is a step-by-step approach that will teach you how to efficiently save for an early retirement. Number 5. Commence your savings efforts early and with vigor. Raise your savings rate. In order to retire early, you will need to have a savings rate that is substantially greater than the typical 10 to 15% that is recommended for traditional retirement. Your timetable and goals will determine whether you should aim for 35% or more of your income. Try to live below your means. Reduce expenses that are necessary and steer clear of lifestyle inflation when your income increases. Any additional income that you receive, whether it be from bonuses, raises, or side hustles, should be invested and saved straight. Put your savings on autopilot. Establishing a system that allows you to make monthly transfers to your retirement and investment accounts will make it much simpler for you to maintain self-control and ensure that you are making consistent payments. Number 4. Make the most of eligible tax-favored accounts. Contribute to your employer-sponsored retirement plan, such as a 401k or 403, particularly if your employer provides a matching contribution. The maximum amount that can be contributed in 2024 is $23,000, and your employer may match a portion of your contributions from that amount. Comparing a traditional 401k to a Roth 401k, you are able to pay taxes in advance with a Roth 401k, which means that withdrawals made during retirement are exempt from taxation. Currently, a traditional 401k allows you to take tax deductions, but when you retire, you will be required to pay taxes on any withdrawals you make. Individual retirement accounts, IRAs, make a contribution to an IRA for either a traditional or a Roth account. The maximum amount that can be contributed in 2024 is $6,500. Roth individual retirement accounts, IRAs, provide for tax-free withdrawals throughout retirement, which might be advantageous for early retirees who may be subject to lower taxes in the future. If the majority of your investments are established in a standard 401k or individual retirement account, IRA, you have the option to utilize a Roth IRA conversion ladder in order to gain access to these funds prior to reaching the age of 59.5 without incurring the penalty for early withdrawal. Each year, you will need to convert a part of your traditional accounts into a Roth individual retirement account, IRA. Accounts for health savings, HSAs. If you have a health plan with a high deductible, you should think about making contributions to an HSA. Tax deductions are available for contributions, growth is exempt from taxation, and withdrawals for eligible medical costs are exempt from taxation. After reaching the age of 65, you will be able to access the money for expenses that are not related to medical care, just like you would with an individual retirement account, IRA. To achieve growth in the stock market, you should invest in a diversified portfolio. There is a requirement for long-term growth in order to retire early, and equities often deliver the largest returns over the course of time. Aim for a portfolio that is significantly weighted towards stocks, 60 to 90%, in order to maximize the potential for growth. Index funds and exchange-traded funds, ETFs, are two types of investment vehicles that are good for accumulating wealth because of their cheap costs and diverse portfolios. When looking to diversify your risk across a wide range of companies and industries, you might consider investing in broad-based funds such as the S&P 500, the Total Stock Market Index, or international index funds. Averaging over the dollar cost. Make consistent investments regardless of the state of the market in order to reduce the impact of volatility over time. By utilizing this method, you can eliminate the need to attempt to time the market. In order to ensure stability, as the date of your retirement of choice draws closer, you should progressively move a portion of your portfolio into bonds. This will help you reduce risk and generate returns that are more secure and consistent. In the event that you intend to rely on your investments as a source of income throughout your retirement years, this is of utmost significance. Bond index funds and Treasury inflation-protected securities, TIPS, are both excellent choices for investors looking for stable returns with low risk, particularly in markets that are volatile. Real estate. If you want to increase your income, you should think about investing in real estate. Both the ownership of rental properties and the investment in real estate investment trusts, REITs, are potential ways to create passive income and diversify your investment portfolio beyond the realm of stocks and bonds. Shares of stocks that pay dividends. Investing in firms that pay dividends on a regular basis can provide a reliable source of income during retirement without the need to liquidate your assets. Number 3, evaluate and make adjustments to your investment strategy. Regular evaluations of the portfolio. At the very least, once or twice a year, you should examine your portfolio to make certain that it continues to be in accordance with your risk tolerance, goals, and time horizon investments. In the event that certain asset classes, such as stocks or bonds, have become overweighted or underweighted as a result of swings in the market, you should rebalance your portfolio. Risk involving sequence of returns. At early retirement, market volatility presents a unique risk, particularly if you are required to make withdrawals from your portfolio at times when the market is experiencing a recession. Create a cash buffer or bond allocation that will meet your living expenditures for the first 2 to 5 years of your retirement. This will protect you from financial hardship. Number 2, create a withdrawal strategy for yourself. Withdrawal rate that is safe. The 4% rule is a typical rule of thumb that claims you can withdraw 4% of your starting portfolio each year, adjusted for inflation, without running out of money. This guideline was developed by the Center for Financial Research. For instance, if you retire with $1 million, you are allowed to withdraw $40,000 in the first year of your retirement. In spite of this, there are some experts who recommend a more conservative approach for early retirees, which is 33.5%. How to fill the void. If you want to retire earlier than expected, you could be required to establish a bridge income in order to cover the years that pass before typical retirement savings, such as 401(k)s and IRAs, become available to you without incurring penalties. In order to accomplish this, taxable brokerage accounts, Roth IRA conversion ladders, income from rental properties, income from side enterprises, or income from part-time work are all viable options. Withdrawals that are tax efficient. Remove money from your accounts in a methodical manner to reduce the amount of tax you owe. To give you an example, you could remove money from your taxable accounts first so that your tax-favored accounts can continue to grow, and then you could go on to your Roth IRA so that you can make tax-free withdrawals. Number 1, think about the other costs, including health insurance. Individuals who retire early will not be eligible for Medicare until they reach the age of 65. Thus, it is imperative that you make preparations for health insurance. Here are some options. COBRA is a program that enables you to continue receiving health insurance from your employer for a period of up to 18 months after you have left your employment. Affordable Care Act, ACA, of 2002 Shopping Center. Your income will determine whether or not you are eligible for subsidies. In order to qualify for lower premiums, retirees can structure their income in a certain way. HSAs stands for Health Savings Accounts. A health savings account, HSA, can be a tax-efficient strategy to save money for medical bills, as was noted earlier. Consider the possibility that inflation will reduce the value of your investments over the course of time. For the purpose of preserving your purchasing power, it is vital to make investments in assets that have a tendency to beat inflation, such as stocks and real estate. Final thoughts. Utilizing a combination of aggressive saving, intelligent investing, and strategic planning is necessary in order to successfully invest for early retirement. You should prioritize the development of a diverse portfolio that expands over time, make the most of contributions to accounts that offer favorable tax treatment, and devise a reliable withdrawal strategy. You will be able to attain financial independence and retire earlier if you begin early, maintain discipline, and make well-informed investment decisions. This will allow you to have more time to enjoy the life that you have worked so hard to construct. If you found this video informative, make sure to give it a thumbs up and share it with your friends. We'd love to hear your thoughts, so drop a comment below and let us know what you think.